Remember 1999? The hype, the excitement, the absolute conviction that the internet would change everything. People were throwing money at any company with a .com in its name, creating a massive bubble that eventually, spectacularly popped. Well, history doesn't repeat itself, but it sure does rhyme. Today, we're seeing the same gold rush mentality, but this time, the magic word isn't .com, it's AI. I'm here to argue that we are smack in the middle of an AI bubble. And just like its predecessor, it's heading for a major correction. But don't worry, this isn't a doomsday prediction. It has a look at why a market crash might be exactly what the AI industry needs to truly thrive. Let's start with the money. The numbers are staggering. We're talking about hundreds of billions of dollars being poured into it. Big tech companies are in an arms race, spending fortunes on building out their infrastructure. Just look at the capital expenditures. Microsoft, Google, Meta. They're all spending tens of billions every quarter, a huge chunk of which is dedicated to AI servers and data centers. Venture capital is flowing like a river into any startup that even whispers the letters A and I. It feels like everyone is terrified of missing out on the next big thing. But here's the catch. Where's the revenue? For every dollar being spent, how much is actually coming back in? Right now, the math doesn't add up. The vast majority of AI revenue is concentrated in a few key areas, mainly cloud services and hardware, specifically GPUs, from companies like Nvidia. The actual software and applications built on top of these massive models are struggling to find a profitable business model. It's a classic bubble indicator. Valuations and investments are completely detached from real-world earnings and profitability. We're seeing companies with no product and no revenue achieve billion-dollar valuations based on nothing more than a promising idea and a team of smart engineers. That's not sustainable. It's the 1999 playbook all over again. This brings me to a fascinating and slightly brutal concept known as the death of the wrapper. What's a wrapper? It's a startup that essentially builds a thin layer of user interface, a wrapper around a powerful, pre-existing AI model. Like OpenAI's GPT-4, you've seen them everywhere. AI for writing marketing copy, AI for creating social media posts, AI for summarizing legal documents. The problem is, these companies don't own the core technology. They're completely dependent on the big players who build the foundational models. So what happens when the creators of those models, like OpenAI or Google, decide to build that feature themselves? The wrapper startup dies instantly. We saw this happen when OpenAI integrated PDF reading and data analysis directly into ChatGPT. Suddenly, dozens of startups offering that exact service became obsolete overnight. It's a dangerous game to play. You're building your entire business on rented land, and the landlord can evict you at any moment without notice. This creates a huge amount of risk and instability in the startup ecosystem. Very few of these wrapper companies will survive in the long run. And once investors realize this, the flow of cash is going to dry up fast. Let's talk about the hardware. The entire AI boom is built on a very narrow foundation. Specialized chips called GPUs, or graphics processing units. And right now, one company, Nvidia, has a near monopoly on the high-end GPUs needed for training and running large AI models. This creates a massive bottleneck. The demand for these chips far outstrips the supply, leading to insane prices and long waiting lists. Your ability to innovate in AI isn't just limited by your ideas. It's limited by your ability to get your hands on these incredibly expensive, power-hungry chips. This dependency is a huge point of failure for the entire industry. What if there's a supply chain disruption? What if geopolitical tensions affect chip manufacturing? The entire AI world could grind to a halt. Furthermore, this hardware dependency inflates costs to astronomical levels. Training a state-of-the-art model can cost hundreds of millions of dollars, a price only the biggest tech giants can afford. This stifles competition and centralizes power in the hands of a few. A healthy ecosystem needs diversity, not a monopoly. The current hardware situation is preventing that. And that brings us to the elephant in the room that no one likes to talk about: power. Not corporate power, but electrical power. AI is incredibly intensive. A single training run for a large language model can consume as much electricity as hundreds of homes use in a year. Data centers are sprouting up everywhere, and their demand for energy is exploding. We're already seeing reports of utility companies struggling to keep up, warning that they may not have enough power to support all the planned data center projects. This is a hard physical limit. You can't just wish more electricity into existence. Building new power plants and upgrading the grid takes years, even decades. The AI industry's growth is on a collision course with the physical constraints of our energy infrastructure. At some point, something has to give. We simply cannot sustain this exponential growth in energy consumption. The costs will become prohibitive, and the environmental impact will become undeniable. This energy constraint is a silent but powerful brake on the AI hype train. So, we have speculative investment, divorced from revenue, a fragile startup model built on rented tech, a critical dependency on monopolized hardware, and an impending energy crisis. It all points to one conclusion: the bubble is going to pop. But here's why that's a good thing. I call it a productive crash. Think back to the dot-com bust in the early 2000s. Yes, a lot of companies failed. A lot of investors lost money. It was painful. But what rose from the ashes? The companies that survived were the ones with real business models, real products, and real value. Companies like Amazon and Google. The crash cleared out all the noise, all the hype, all the unsustainable get-rich-quick schemes. It forced the industry to focus on what actually works. It separated the signal from the noise. The same thing will happen with AI. When the bubble pops, the speculative money will disappear. The AI for everything hype will die down. The wrapper startups with no real moat will vanish. What will be left are the companies and applications that solve genuine problems and create tangible value. The focus will shift from building ever larger, more power-hungry models to creating smaller, more efficient, and specialized. As the hardware market will be forced to diversify, leading to more competition and lower costs. We'll see innovation in energy-efficient computing. Crash will force discipline and focus. It will be a painful but necessary cleansing that allows a healthier, more sustainable, and ultimately more innovative AI industry to emerge. The end of the hype cycle is not the end of AI. It's the beginning of its mature phase. It's the moment AI stops being a buzzword and starts being a truly transformative and integrated part of our world, built on a foundation of reality, not hype. The boom was fun, but the real work begins after the bust. So as you see the headlines and hear the frantic predictions, just remember the lessons of the past. Bubbles are a natural part of any technological revolution. They're messy, they're irrational, but they pave the way for what comes next. The AI crash isn't something to fear. It's something to prepare for, because the opportunities that will arise on the other side will be the ones that truly change the world. Thanks so much for watching. If you found this perspective interesting, make sure to like this video and subscribe to the channel for more deep dives into the tech world. Let me know what you think in the comments below. We're in a bubble, or is this time different? See you in the next one.